All right, guys, let's go ahead and get started here. Welcome, everyone. My name is Tony Zhang. I run the product strategy team here at OptionsPlay. For those of you that are, have found us through the TMX, I welcome you guys. For those of you that are new, this is going to be a webinar where we're going to be talking about how to use options, especially for those of you that are new. Before I get started, I just want to do a quick sound check. If everyone can hear me, just please type in yes into the chat window. Okay, great. So like I said today, what we're going to be talking about is really helping those of you that are relatively new to options trading, how to get started. Today, I'm going to spend a little bit of time talking about why you guys should consider using options, and we're going to talk about a couple of different strategies that you can use. But what I'm really going to do is I'm not going to go too in-depth into some of the mechanics of options trading. What I really want to do is just talk a little bit about the benefits, why you should consider using options, some of the basic strategies, but most of the time what I really want to spend the time on is showing you the platform that's designed to help those of you that are new, help you get off the ground, help you get started. Because I think a lot of people struggle with the initial learning process of options, so that's why we really want to take the time and walk you guys through the platform, as opposed to kind of boring you on some of the minute details of options trading, because that's stuff that you can find. There's a lot of courses online that you guys can read on that, but there's no substitute for showing you how to take the academics or what you learn online into the real world, and that's really what I'm here to do for you guys today. Now, before I get started, can those of you that are new to options trading, please just type in new into the chat window, and for those of you that have some options trading experience, please type in no, so that I have an idea as far as kind of the audience here. So pretty much everyone has typed in new. I got a couple of no's. Okay, so most of you guys are new. A couple of you guys have experience. What I do want to point out is that despite the fact that the title of this option is your first option trade, and many of you are new and have never traded an option before, I do want to point out for those of you that have traded options, you're still going to find this webinar useful because the tool OptionsPlay is designed for all types of traders, whether you're brand new or experienced. This tool is designed to help you very quickly identify where your starting point is, regardless of what your views on the underlying market is. So even if you have traded options, I hope that you'll still find the walkthrough of the platform very useful because it's designed for experienced traders as well. So let's go ahead and get started. I just want to make sure everyone should be able to see the overview screen here. So just to give you an understanding as to what we're going to cover here today, I'm going to try to spend the least amount of time on the PowerPoint as possible. I've made the PowerPoint as short and concise as possible. I want to spend most of our time showing you how to actually use the actual platform. So first of all, what I want to do is cover the two basic strategies. And this is really going over why you guys should use options, why you should consider adding options to your portfolio. There's two basic strategies that we'll cover, one of which is speculative, meaning if you have a directional view on the market, whether you're bullish or bearish, this is how you can use options to take advantage of that. The second strategy we'll cover is called the covered call. This is a strategy for those of you that have buy and hold investments. So if you buy some stock or ETFs that you have in your account that you're holding on to, you can use options to generate some income on those existing assets that you have. So that's what a covered call strategy is. So those are the two strategies, the two basic strategies that we're going to cover today. Now, the underlying theme before you use any options is still always rooted in the stock analysis, meaning you have to have a good grasp as to what's going on with the underlying stock or ETF before you utilize options. So I'm going to spend a little bit of time talking about that and showing it to you on the platform, how you can use OptionsPlay to do analysis on the underlying stock. And then for those of you that have traded options or have read about options, you might be familiar with the term called the Greeks. There are many Greeks, but today I'm going to cover two of the important ones that that you need to be aware of before you start trading options, because they are critical in understanding how you can profit from options. So we'll cover those 2 Greeks. And again, the whole point of this process is not to necessarily bore you with details, but to actually show you how these Greeks are applied in your trading, and that's really where OptionsPlay comes into play. So I'll be showing you the Greeks on the platform itself. And lastly, what I want to do is talk a little bit about some of the common mistakes that beginners make when they're starting out with options. Hopefully you won't make those same mistakes. We're going to guide you towards where people tend to make mistakes and show you what you can do to kind of correct yourself. And lastly, like I said, we're going to spend most of our time actually showing you the actual platform so you can see how to utilize what we're teaching you today. The goal here is that after you leave in the next 45 minutes, you will feel confident enough to use this platform, even if you're brand new to options trading, to start looking at strategies and start analyzing them and making decisions as to whether or not this is for your portfolio or not. So I just want to cover some basic strategies. I just see one thing in the chat window saying about slides. Can you guys all see the slide in front of you that says basic strategies? If you can see the slide that says basic strategies, just please type in yes. Okay, great. Everyone can see it. Okay. So talking about basic strategies, there's 2 main reasons that I want to cover today as to why you guys should consider adding options to your portfolios. Number 1 is speculative, which means that you can you use options when you have a directional view on an underlying stock or ETF. So if you've traded stocks before, if you've done any form of trading, the chances are you have stocks that you're looking at that you either have a bullish or bearish view. And if you have a bullish or bearish view on any stock or ETF, then options is a strategy that you might want to deploy on that individual stock. And one of the reasons that people turn to options is what we call asymmetrical payoffs. What does that mean? That means that when you are right, you get paid the same way you would if you were either long or short a stock. But if you're wrong, you actually have limited risk. Okay, so when you buy a stock, the risk is the stock goes to 0 and you lose everything. When you buy an option, you also have that same risk, but the amount of money that you're risking is substantially lower than what it would take to buy a similar number of shares of stock. So that's really why people look at options, because you can take advantage of the same upside, but if you're wrong, if your analysis on the underlying stock is wrong, you risk substantially less money. And that's really why options sometimes is very attractive to a lot of people, especially if you don't have a lot of capital to deploy to trading. You can take effectively what is leverage, but limited in terms of risk, bets on the underlying stock or ETF. So the 2 strategies that you can use for this type of trading is calls and puts. And calls are used if you have a bullish view on the underlying stock. So if you're bullish on a stock like BMO or TD Bank, you can buy some calls in order to take advantage of a stock going higher instead of buying the stock. Conversely, if you are bearish on a stock, like some of the mining stocks like ABX, Barrick's Gold, if you have a bearish view on the underlying stock, this is where options separate itself a little bit from stocks, because if you're bearish on a stock, you have to go out and borrow that stock in order to short it, and that's presuming that you have the ability to short a stock, that's presuming that you have the margin to do it, and that's presuming that the stock is even available to borrow. So there's a lot of things that you may not want to do with shorting a stock. So that's why buying puts is a much more attractive way to potentially take a bearish view on a stock, because you don't have unlimited risk when you just like when you short a stock. But when you buy a put, you can still take advantage of that stock going lower. But even if you're wrong, you're limited to what you've paid for that put. So that's really why these 2 strategies are the 2 most simple strategies if you're starting out for bullish and bearish views. Now, if you've taken any time to learn about options, you'll know that options have two pieces of information that you need to decide in order before you trade an option. And that number one is the expiration date, meaning every option expires, so you need to pick the date as to when that option expires. And number two, there are strike prices. So you have to pick an expiration date and a strike price whenever you're buying a call or a put. And the question that I always get is, how do I know which strike price to choose? And the general rule of thumb for those of you that are beginning and starting out is that you generally want to pick relatively shorter dated options, anywhere from 1 to 2 months out, somewhere in that range, as a starting point, because that's the time frame that most of you have some visibility into. Most of these strategies, you might use charts to determine when to buy and sell. So those types of strategies usually last for a few weeks to a couple of months. So you generally want to pick expirations anywhere from 1, even going out to 3 months is okay. And then as far as strike prices go, you generally want to pick strike prices that are pretty close to the current price, or what we call the at-the-money strikes. So we'll go over those in detail with some real-life examples using the platform. But just so you know, if you're starting out with options and you have a bullish or bearish view, you can buy some calls if you're bullish, you can buy some puts if you're bearish. Now, the second strategy that's most common, and this is probably more applicable to most of you because almost all of you probably have some stock that you hold in your account. This might be stocks that you're holding on to for the long term. This might be stocks that you were trading for the short term. Regardless of what it is, they're assets that are sitting in your account. And because there are assets in your account, you can generate some income by selling calls against that stock position that you have. And by doing that, you can actually collect some income. So this is actually the most popular strategy that most users use options for, is collecting income by selling calls against the stock that you hold in your account. Now, this generates income on the stock positions you have. The requirement here is that you need at least 100 shares of a stock in order to sell a call, because each call option is representative of 100 shares. And what you're effectively doing when you're selling a covered call is you're essentially giving, you're selling the right to sell your stock at a particular price. And this does mean that you risk losing your stock. So this is a strategy that's used if, let's say, you own some stock and you're okay with selling it at a higher price, meaning if the stock is trading at $100 and you're okay with selling it at 110, then you can sell a 110 call against it. So in the future, if the stock goes above 110, you've essentially sold your stock at a profit, and generally speaking, by doing so, you're collecting some income for doing so. So this is a very popular strategy, especially amongst traders that have buy and hold investments that they have in their account. This is a great way to utilize options to generate some additional income. So again, this is just talking about the mechanics. What I really want to do is show you how to actually do it on our platform. So we'll get to that in 1 second. So keep in mind, these are the two main strategies that I'm going to cover today. Number one, if you have a bullish or bearish view on some stocks that you want to take a bet on, you can buy some calls and puts for. If you own some stock that you're just sitting on right now, you can utilize options to generate some income. So those are the two examples that we'll go over today. Like I said before you trade options, you do have to have a good understanding as to what's going on with the underlying stock, because it will affect how you trade your options. So number one, direction is probably one of the most important factors that you should be aware of before you trade an option. And what that means is you need to have a general understanding that, is this stock trending higher? Is this stock trending lower? Is this a bullish stock? Is it a bearish stock? Because that will help you determine whether you buy calls or puts, for those of you that are looking for directional strategies. And when you're selling covered calls, it will help you determine what strike prices to sell your calls at. So it's really important to understand what the directional view is on the underlying stock. And that is something that OptionsPlay will help you do. So that's something that I'll go over as well on the platform itself. The other thing that you must look at when you're trading trading options is having an exit plan, and that exit plan should be based on the underlying stock. So if you're bullish on the stock, you should have a target price, so that when the stock hits that target price, that tells you to exit the trade or exit the option. So you should have these entry and exit target prices before you enter a trade. You should never figure this out after you're in a trade. So if you're buying a call because the stock's trading at 100 and you think it's going to go to 110, you should have that 110 target ahead of time, so that when the stock does hit 110, you know it's time to take profit. This is one of the rules of trading, whether you're trading stocks or options. This is one of the rules that you should follow, but it's extremely important when you're trading options to have an exit plan based on the underlying price. Now, I talked about if you're buying a call because the stock's trading at 100 and you think it's going to go up to 110, you should also think about an exit plan if the stock goes against you. So if you think that the stock's at 100, you think it's going to go to 110, but 2 weeks later it's down at 95 or 92 or 90, you should also have an exit plan at some point to say, hey, I was wrong in my initial analysis. I need to get out of my options trade so that I don't lose more money. So you make sure that you have an exit plan on both sides of the market. And lastly, as a general rule of thumb, especially when you're starting out, I do recommend that you start looking at, when you're buying calls and puts, to look at strike prices that are just a little bit in the money. What that means is that if the stock's at 100 and you think it's going to go to 110, instead of buying a 100 strike price call, you might want to buy a 95 or a 97.5, a call that's slightly in the money. And the reason for this is because when you're first starting out, you want to make sure that you're not as time sensitive. And when you're buying an in the money call, you're slightly less time sensitive to the move in the underlying stock. And I'll discuss this in a second on the next slide, talking about the Greeks. But I do recommend that if you're new to options trading and this is your first time buying a call or a put, to consider buying a call or a put that's slightly in the money, because there is some benefits there's a little less sensitivity to some of the things that you need to be aware of on the next slide when you're buying an in the money call or a put. And lastly, I do want to cover, because every single one of you are probably going to be a little different when it comes to doing your analysis on the underlying stock. Some of you are technical analysis traders. Some of you are more fundamental analysis traders. I do want to point out that if you're a technical trader, meaning you use your charts to determine when to buy and sell, these are generally shorter term setups. So I generally recommend that you trade expirations that are from 1 to 3 months out. For those of you that are doing fundamental analysis, so you're looking at balance sheet statements, you're looking at earnings calls, and you're basically making a bet on valuation, these are generally more longer term views, so you might want to trade options that are maybe from 3 to 12 months out. So those are the two main kind of philosophies that people tend to follow when it comes to trading. So if you're trading with the charts, you generally want to trade shorter dated options. If you're trading more fundamental based on valuation, you want to look at more longer dated options, because it will take more time for your fundamental views, generally speaking, to take fruition than shorter term chart based analysis. So if you've done any type of reading on options trading, you may have come across a term called the Greeks. The Greeks is essentially they are ways to help you understand how the price of the option will change, but with respect to other things. And there are a lot of different Greeks, but there's really only two that you need to pay attention to, especially as a beginner, because these are the two that are most important, and these are the two that have the largest effect on your option price. First one is called delta. What delta does is it tells you how much the stock price or how much the option price will change for every dollar the underlying stock moves. So what that means is that if you buy a call and the stock is currently at 100 and the stock goes up to 101, the delta will tell you how much the option will increase in value when the stock goes up by $1. So if you see a delta of 0.5, that means for every dollar the stock moves, the option will move 50 cents. So if the stock moves $1 in your favor, you'll gain 50 cents on the underlying option. Conversely, if the stock moves $1 lower, you'll lose 50 cents on the option price. So this is where it's important to understand when the stock moves a certain amount, how much is your option move? And that's what delta tells you. Now, you don't necessarily have to memorize this because the platform is designed so that you can just simply say, what happens if the stock goes up by $5? What should my expected profit be? You don't have to necessarily memorize this, but it's something that you should be aware of, is that when the stock moves, your option will also move, and the delta will tell you how much it'll move by. You don't have to calculate any of this manually, by the way. Almost all platforms nowadays will do these calculations for you. So it's just more for you guys to be aware of this rather than understanding how it actually works or how to calculate it. The other thing is theta. This is how the price of the option will change in respect to time. Because options have an expiration date, the time actually has an effect on the value of your option. So the option prices will actually decrease in value at a predetermined rate the time you buy the option or sell the option and expiration. How much does it actually decrease by? That's what theta tells you. So it's really important to understand that the longer you hold on to an option, the more value gets eroded, or what we call time decay, based on this concept of theta. So I'm not going to get into the intricacies as to why this happens, but it's important for you to understand that when you're buying an option, this theta is always working against you. So you're losing time value as time goes by. If you're short an option, such as in a covered call, this is when time value is actually working in your favor. You want time to go by because as that time value goes by, it erodes the price of that option, which makes it cheaper for you to buy back, which is profit in your case. So depending on whether you're buying options or selling options, theta is an extremely important thing to understand. But the general rule of thumb is that when you're buying an option, such as buying a call or a put, time is working against you. When you've sold an option, time is working in your favor. Okay, so just keep those two concepts in the back of your mind because we will cover how they will actually how we can utilize them and how we can see those dynamics change based on different expectations we have for the stock. So just moving on to talking about some of the common mistakes that some people make when they're trading options. What I've done is I've broken down this into two sections. Number one, buying options. This is what we talked about if you have a bullish or bearish view. What are the common mistakes people make there? And then selling options. When you're doing cover calls, what are some of the mistakes that people have there? So when we're talking about buying options, buying calls or puts, the number one mistake that a lot of people make is they tend to hold on to a trade until expiration. So you might be trading a December option right now here in November, and you might be buying a call because you think BMO is going to go higher, so you buy a BMO call. One of the common mistakes that people make is they hold on to that call all the way through the December expiration. And this is where I talked about theta. Theta is working against you. Time decay is working against you. That's why, generally speaking, you don't want to hang on to an option for too long, all the way till expiration, because then you're losing all that time value. If the stock moves in your favor, take profits early. If the stock's not moving in your favor and it's going sideways or maybe even going against you, also cut your losses. Don't hold on to that call until expiration, because if you do, that call will erode down to zero and you will lose all your money. So that's why, generally speaking, when you're long an option, have that exit plan. So the stock goes in your favor, you get out immediately. If the stock goes against you or just goes sideways, also get out so that you don't risk more money. Okay, so when you're buying an option, generally speaking, you don't want to hold it all the way to expiration. You generally want to get out before an expiration date. The second mistake that a lot of people make is they use too short of an expiration. What does that mean? If you're bullish on BMO and you think it's going to hit a certain price target by the end of the year, then you don't necessarily want to trade a December expiration. You might want to trade a January or February expiration. You want to give your option a little bit more time than you anticipate, because chances are the stock may not make the move that you expected to in the time frame that you want, and it might take a few extra weeks or a few extra days. You generally want to give yourself some buffer, because chances are you're never going to be able to get that target price exactly down to the exact date. So you generally want to have some buffer. So if the stock does move, but it happens to make the move the week after you expect it to, you still have that time in order for the stock to move. So if you think the stock's going to move in a certain amount of time, make sure you add a few weeks to about a month to the end of that date, and that is how you help, and that's how you should use to pick your expiration dates. Lastly, the most common mistake, and this is across all strategies, is not having an exit plan. So if the stock's trading at 100, you think it's going to go higher, but you're not sure how much higher it's going to go, and you don't really think about it. And next thing you know, the stocks move up to 105 or 110 or maybe even 115, and you don't know when it's time to get out. That's probably the worst case scenario you could possibly be in, because you don't know when it's time to take profits or when it's time to cut your losses. So make sure, regardless of what type of strategy that you're doing, you have an exit plan. Now let's move on to selling options. So this is for those of you that are selling cover calls. The most common mistake that we see is users trying to get too aggressive when they're selling cover calls. And this is usually caused by when they sell a cover call, they feel that the income that they're getting is not enough. So they try to get a little bit more aggressive. They're selling, if the stock's at 100, instead of selling a 110 call, which might only yield 15 cents, 20 cents, they'll try to sell a 105 call or maybe even a 102.5 call, because that'll pay you $1 or $1.50. And it sounds that's a lot more attractive to get $1.50 in income than it is to get 15 or 20 cents. But that's actually where we see a lot of users tend to make that mistake, because in trying to make that extra dollar, you've given away substantially more upside on the underlying stock. And you're in that stock for a reason, because you think the stock's going to go higher. So don't get too aggressive when you're selling your cover calls. The other, and along the same vein, we see users that are searching for that 110 call. Maybe they find that it's only paying 15 or 20 cents, and they might think that that's not enough. So they'll go out an extra 2-3 months, and they'll find that the 110 call a few months out is paying maybe 40 or 50 cents, or maybe even 60, 70 cents. So they'll sell a call that's 4 or 5 months out, meaning a much longer call than they originally had anticipated, just to try to make an additional 50, 60 cents. Again, based on our research, not worth it. You generally want to sell shorter dated options when you're short an option. And lastly, when you're selling covered calls, again, you must have an exit plan. If the stock shoots higher, you need to know when you need to get out, and the stock goes lower, you also need an exit plan. So I don't have enough time to get into all of the details of what that means, but we do a lot of these webinars on very specific strategies. So I do a webinar specifically on just bullish and bearish strategies, and I also do a webinar on just cover calls, and I do get into the details of what you should be looking for your exit strategies. But again, I don't have enough time to cover all of that today. So this is just more of an overview. And then again, we will show you how to utilize the platform, which is probably the most important piece that we'll cover here today. And for those of you that are interested in any one of these strategies in particular, go to our YouTube channel. We have some of these pre-recorded webinars on this specific strategy, so you can find out a little bit more, but we will do more in the future as well. So lastly, what I really want to do is spend the time showing you guys OptionsPlay. So for those of you that have never seen OptionsPlay, this is a platform that's available to you at optionsplay.com/TMX. It's a free platform. You can sign up at optionsplay.com/TMX. This is the platform that you'll see that I'm going to be giving the demo with today. I highly recommend, for those of you that don't already have access, to go in and sign up. And this webinar is recorded, so that if you don't have the time to sign up right now, you can follow along afterwards with the recording. So for those of you that are new to OptionsPlay, this is the screen that you'll see when you log on. This is only, the free version is only for Canadian securities, but it is completely free of charge to you thanks to the TMX. And the platform itself is divided into 3 sections. I have trade ideas and watch lists here on the left. I have equity analytics panel here in the middle. And on the right-hand side, I have trading and income. These 3 panels, we call it the what, why, and how of options trading. Because every single morning you log on, you want to know what symbols should I look at. That's why we have trade ideas, which are fresh symbols designed to give you fresh bullish and bearish ideas every single day, or a watch list so that you can set up, we have a default watch list set up, but you can also create your own watch list so that you can create a watch list of all the stocks that you want to take a look at for the day. In the middle, we have our equity analytics panel. This is designed to really give you an idea, a snapshot data of what's currently going on with the stock. I mentioned that it's very important for you to understand what's going on with the underlying stock before you make an options trade. So this is designed to give you some insight into that. So one of the things that we provide up front is the 1-month and 6-month trend. So we'll show you what the current short-term and long-term trend of the stock is. So as you can see here for BMO, 6-month trend is bullish, 1-month trend is neutral, and we actually show it to you on the chart below how that trend has changed. So as you can see, since November 2nd, both the 1-month and 6-month trend turned bullish and the stock continued higher up until just a couple of days ago here on November 9th. That's when the 1-month trend turned neutral. So if you're a long-term trader, this is still a bullish stock and a bullish trend. If you're a short-term trader, this rally may have an end for now, but that doesn't mean it won't continue. So this stock could move a little higher, and you might see the 1-month trend turn back to bullish. So this gives you an idea as far as what the stock has done over the short and long term, and we have what's called the technical score. These 2 indicators in conjunction with each other is very powerful because the technical score gives you an idea as far as how strong the stock is compared to the relative market. So this is a relative strength indicator, and it gives you a quantifiable way of determining, is the stock stronger than the overall market? Is it weaker? Is it about the same? So a score of 7 is relatively strong, and it's on a score of 1 to 10. 10 are the strongest stocks in the market. 1 are the weakest stocks in the market. So the fact that BMO has a technical score of 7 tells me it's a relatively strong stock. And the fact that the 1-month and 6-month trends are neutral or bullish, this tells me that there's more of a bullish bias on this given stock. But the fact that it's pulled back recently is perhaps, for those of you that are bullish on this particular stock, perhaps a good pullback or a good entry on this particular pullback. And then we have things like earnings and dividend data, so you know when that next earnings is. Very important for those of you that are trading options to understand if there's earnings between now and the expiration date. So this will actually tell you the next earnings is on December 5th. It'll also tell you what the current dividend pays, and if we have an ex-dividend date, you'll actually see that dividend date down here as well. So currently, BMO does not have an announced dividend date coming up. So once you have that underlying view on the underlying stock, this is where the trading and income side comes in. So the trading side is designed to give you trading ideas. So talking about if you have a bullish or bearish view, this is designed to help you quickly hone in on what's the strategy to use if you're bullish or bearish, and give you the analytics in order to decide, is this option strategy suitable for you? So this is what we're going to spend most of our time on today, is showing you how you can quickly use this tool to identify bullish, bearish, or income strategies on any stock that you're looking at. So I'm using BMO here as an example. BMO, like I said, based on all the things that I'm looking at, I'm relatively bullish on the stock, and I actually think this pullback over the last couple of weeks actually is a good potential entry point for going long. So this is the stock that I'm particularly bullish on. It's a relatively cheap stock, and this pullback provides a decent opportunity to potentially get long this stock. So what this does is, and you'll notice that here at the bottom of your screen, you'll have 2 buttons. It says I'm bullish or I'm bearish. So based on the current analysis, I'm going to be looking at some bullish strategies. So when I click on I'm bullish, I'm going to be presented with these three strategies. Today, we're just going to focus on the first two because these are the beginner strategies. For those of you that have never traded an option before, you're probably familiar with trading stocks. So here it shows you to buy 100 shares of BMO costs you $9,800. Quite a bit of money to buy 100 shares of that. However, if you were bullish on this stock, one of the things that we're telling you to do is you can look at buying a December 98 strike call. So what that does is that call only costs you $161. And as you can see, the two payoff graphs are similar. However, you get the similar upside, so the stock goes higher, you'll make money on the call, you see that green area. But as the stock moves lower, here as you can notice, I keep losing more and more money as the stock moves lower. But when I buy a call, my risk is limited to what I've paid. So here I've paid $9,800 to buy 100 shares of BMO. Here I can get a similar risk profile for only $161. So how can we decide which one's best for me? So that's where we're going to look at the P&L simulator here at the bottom, and that's going to help me determine, is this a strategy that's suitable for me or not? So, like I said before, if I'm bullish on BMO, I'm thinking that this thing's going to go to at least maybe 102, 102.5, which is that next resistance level that I see up there. And if the stock moves down to maybe this 94 area, that's where I know I'm probably wrong on this trade. This is not a stock that's going to continue going higher. It's probably going to continue pulling back. It probably doesn't even need to go down to 94 for me to make that decision. Even if it goes down to 96, I think I would be pretty confident in saying that these trend indicators would probably turn bearish, and it's probably time to get out of that trade. So let's just take a look at a couple of those examples. So if the stock is currently at 98.29, one of the things I can say is, let's compare these two strategies. Let's say the stock doesn't do anything and it just stays exactly where it is at 98.29. Here, as you can see here, I'd basically be flat on the underlying stock if I had bought this stock at 98, well, it's 98.32. So if the stock goes to 98.32, as you can see on the stock, I'm flat. But as you can see on the call here, I've lost a decent amount of money. I've lost $129. So if I think the stock's going to stay flat, as you can see, buying this call option is certainly not a good strategy to do. Okay, so let's just be aware of that. If the stock stays where it is, you're going to lose some money. So if you think the stock's going to stay where it is, a call option is not something that you should buy. So let's take a look at what happens if the stock moves a little higher. What happens if the stock goes to 100? The stock goes to 100 here, I make $168 profit. That's a 1.17% return on my money. So out of the $9,800, I'm making 1.7% because the stock has moved up by 1.7%. But if I had bought this call option, I have a 24% return because I make a $39 profit. But because I only paid $161 for this option, that's a nice 24% return. Even the stock moves mildly higher. It was just at $100 just about 2 weeks ago. So it's not too crazy that between now and December 15th, which is roughly a month away, or exactly a month away, that the stock might move back to $100. So if I think the stock's going to move back to $100, this call option is certainly a strategy that I might want to consider. Now, I talked about, I think the stock might go to 102. So let's see what happens if the stock goes to 102. If the stock hits 102, this is a substantially more compelling way to trade this option, because if the stock moves to 102, I make a 3.7% return by buying the stock. But if I had bought this call, I'd make a 148% return because it cost me so little to buy this. Compared to $9,800, only cost me $161. But I get the similar upside. So as you can see here, I'm making $239 profit, which is still less than what I'm making on the shares. But because I put out so little money to trade this, I'm making a substantially higher return, on an order of magnitude higher than if I had bought the shares. Okay? So now let's take a look at the exact opposite, right? What happens if I'm wrong? What happens if the stock drops back to 96? Here, I lose 2.3% return. But as you can see, that's a $232 loss. So if I had bought the stock at 98.31 and the stock moved down to 96, I'm losing $232, which from a percentage standpoint isn't very much, But from a dollar perspective, it's actually higher than what I would lose if I had bought this option. So if I bought this option and the stock just went absolutely nowhere and went a little lower, I actually lose less money here on the option, on the call option, than I do if I bought the stock. If I move down to 94, which is the level that I was talking about before, as you can see here, I'm losing more money on the stock. I'm now losing $432 on the stock, but on the call option I bought, I'm still only down $161. This is why this asymmetrical payoff, if it goes in my favor, I make a hand over fist more money than I had bought the stock. But if I'm wrong, I'm limited in my loss. I'm limited to what I've paid for this call option. So no matter what, I cannot lose more than what I've paid for this call option. Just like when you buy the stock, you cannot lose more than what you've paid for the stock. So this is why the options, generally speaking, is an attractive way to potentially make a short-term bet on an underlying stock, and it requires a lot less capital in order to get started. So either if you have less capital to risk or you just simply have less capital to begin with, options is a possible way for you to take short-term bets, whether you're bullish or bearish on the underlying stock, for substantially less capital. And if it works in your favor, you might get a higher return. And if it goes against you, you might lose a little less. The only time where this is a bad strategy is if the stock stays where it is. If the stock stays where it is, on the underlying shares, you're going to basically be flat, but on the option, you will lose money. So keep that in mind, okay? The other thing I do want to point out here is the stock makes a move, right? Let's say it moves to $100. But instead of doing it by December 15th, let's say it does that by Black Friday, which this year is, actually, I'm not sure if you guys celebrate Black Friday in Canada, but it's a big day we have here in America where the day after Thanksgiving, everyone goes out shopping and they go mad and they spend all their money at Walmart and all the places that you can have all these deals at. But if on the day after Thanksgiving, Bank of Montreal moves up to $100, here as you can see, I make a 42% return, okay? So if the stock moves up to $100 by expiration date, and actually it's the 24th this year, Black Friday is on the 24th. So if the stock moves up to 100 by next Friday, I'm going to make a 46% return on the call, but I'm only going to make a 1.7% return on the stock. However, if let's say it stays at 100 until expiration, notice how the call option starts to lose value. This is the theta, or the time decay, that I was talking about. So even if the stock stays exactly where it is, as time goes by, that call option is going to lose value. That's why you need to have this exit plan, so that if the stock hits that $100 mark on whatever date, if it hits on the next Friday, I want to get out and lock in my 46% profit. Because if I hang on to this call and I hang on all the way to expiration, instead of making a 42% return, I only make a 24% return. That's the time decay working against you. This is why it's really important that when you have an exit plan, once it hits that target price, get out. Don't hang on to a single day longer, because if you do, you're going to lose some money, okay? So let's move on to the next one. I want to give you guys one example of a bearish, actually before I move on, sorry. If let's say everything we've looked at, everything looks good. This is a trade that looks attractive to me. You know, I think this thing could hit 100 next week. So, you know, and based on that, I'll make a 42% return. It sounds all good to me. How do I place this trade? So one of the things is that you can hit the trade button. And one of the things that we'll do is we'll show you how to enter this trade into your broker's platform. So whether you trade at TD or Questrade or whoever your broker is up in Canada, this is how you can enter this trade into your broker's platform. And we also have a thing called a strategy checklist. This is designed so that you don't make the same mistakes that we made as traders. So it goes through a set of checklists to make sure you understand the risks that you're taking. So first of all, it's telling you that you're trading. This is neutral because it has a neutral trend. So it's not you're basically taking a bullish trade on a stock that has a neutral trend. This is just letting you know that you're trading a bullish strategy on a neutral stock. This is also telling you that you're trading a bullish strategy in a neutral market. So it's looking at the trend of the composite index, of the TSX composite index. It also looks at the OptionsPlay score. This is a risk to reward metric to give you an idea as far as how good is the risk reward on this particular trade. So an 85 here is good. But it also is telling you that there's earnings between now and expiration. So that's something to be aware of, is that you need to know, is there earnings between now and the expiration date, because that can cause a lot of movement on the underlying shares. So if earnings is really good, the stock might take off after December 5th. If earnings is really bad, the stock might tank. So this is an event that you need to be aware of that is going to change substantially the value of your option between now and expiration. And lastly, we check for spread and liquidity. So we want to look at how liquid something is before you trade it. In this particular case, this is telling you this call option is very liquid. So it looks like, you know, everything is kind of lined up. So as long as I know that I'm okay with taking these risks, I can go ahead and enter this order into my broker's platform. Now, I've already spent 45 minutes talking about this, so I do want to take some time and look at some bearish strategies. I was looking at Barrick Gold here. Some of the mining stocks, I know is very popular, but they've taken a huge beating over the last few months. So I do want to take a look at, if you have a bearish view on a stock, how can you take advantage of options? So this is where ABX Gold, as you can see, 1 month and 6 month trends are bearish. Certainly not good looking for the stock. It's got a technical score of 2, telling me it's one of the weakest stocks in the market. And as you can see, this stock has been bearish since November 16th. We turned bearish here on November 16th. As you can see, there was that $20 support, which was, support here, support all around here, and then on October 26th, it finally broke below that and continued lower. So based on all of this, this certainly doesn't look bullish. For those of you that are contrarian, keep in mind that you might say, hey, this thing's taken a huge beating. I think it's going to recover now. You can do that. You don't have to listen to our analysis. You can click on I'm bullish, and we'll show you 3 bullish strategies. So if you want to buy a call on ABX, here you go. Here's how you can analyze some bullish strategies on ABX. So we're not necessarily telling you to trade in. We're giving you all the analysis, but you can always override our analysis with your own analysis. But here, I'm going to be looking at some bearish strategies. Keep in mind, this is not a recommendation to go out and trade ABX or BMO. This is just saying that if you're bearish on ABX, here's what you can do. So traditionally, you might be able to short the stock, but many of you may not have the margin requirements to do so. You may not want to short the stock and take that unlimited risk. So buying a put is a much better way to potentially take advantage of a bearish move on the underlying stock. So what this is now is looking at the December 15th, which again, just like our call, it expires a month from today. And we're looking at the $18 put, which is the put that's very close to the current price of that stock. So it's currently priced at $17.82. This is telling you to buy an $18 put. And we do the same exercise we did before. So this stock hasn't been this low in a long time. So there really isn't much of a target price to go off of. So I might say I think this thing is going to go to 17 or maybe 16.5. So let's say what happens if the stock goes down to 17? As you can see, even if I was to short the stock, I make a minus 4.55% return. And this is not putting into account your margin interest and all the other things that you might have to pay in order to do this. This is assuming that you can short the stock effectively for free. You're only going to make a 4.55% gain if you had shorted the stock. If you had bought this put, you make a 58% return, because instead of shorting this and having a margin requirement of roughly $1,700, this only costs you $63 per contract. So you can buy as many contracts as you want, but for each contract you're risking $63. And if the stock goes down to $17, which, based on the movement that it's seen here, it looks like that can make that move in just a couple of days. You're making a 58% return on the buying a put, as opposed to only a 4.55% return if you're shorting the stock. Conversely, if this thing went down to 16.5, which is a little bit more aggressive, you're looking at a 138% return on buying that put versus only a 7% return on shorting the stock. And conversely, if I'm completely wrong, the stock takes off and goes back up to $19, which is still very possible. Here, if I shorted the stock, I'd lose $119 for every 100 shares. On this put option, I'm limited to the amount of money I've paid for that put. So $63 is the maximum amount of money I can lose, even if the stock takes off all the way back up to that $20 range. I'm limited in the amount of money that I can risk here to $63. And again, if this is a trade that I'm looking at and I want to make a trade, click on the trade button, go through the strategy checklist again. It knows that I'm trading a bearish strategy on a stock that's very bearish. So it's giving me that green sign. Market trend, because the current trend is neutral, it's telling me that this is kind of a toss-up here. The OptionsPlay score of 90 is good. It's not great, but it's okay. It's good enough. There are no earnings between now and expiration, so I know that there's nothing huge that's necessarily going to move the markets between now and December 15th. And lastly, the bid-ask spread is also pretty good. So great. These are all things that I might be looking at before I enter this trade into my broker's platform. So keep in mind that regardless of any stock that you type in, let's say we look at TV, we give you the underlying analysis so that you can quickly decide whether you're bullish or bearish on this underlying stock. You can click on I'm bullish or bearish and be presented with 3 strategies. And you don't have to go out searching for an expiration date, searching for strategies, searching for a strike price, and then doing some analysis. It does it all for you. Presents the two side by side, so you know exactly buying 100 shares, how much that costs, buying a call, how much that costs, and then use the P&L simulator to decide, hey, based on my views on the underlying stock, am I getting enough gain for buying the option compared to buying the stock? And being able to compare the two side by side so you know exactly what your risk to reward is. If it goes in your favor, how much money you should expect to make. If it goes against you, how much money you can expect to lose. And then be able to click on trade instantly and get the trade that you can enter your broker's platform. So if you have any bullish or bearish views on any underlying stock, click on the trade button. We'll help you get started. Now I just want to lastly talk about income strategies. So if those of you that own TD stock, right, and I know a lot of you do, you should consider using cover calls to generate some additional income in your portfolio. And the income panel does the exact same thing. It provides you with that starting point. Now, I'm not going to get into the details of the income panel today, but we do have settings that you can create for yourself. For those of you that are selling cover calls, we have a whole webinar covering this specific strategy alone. So for those of you that are interested in the strategy, I highly recommend you go to our YouTube channel, check out those webinars. I'll send you a link with the recording of this particular webinar. But based on what this does is it finds cover calls based on your own personal preferences. And I'm not going to get into those preferences today, but all the strategies that we recommend to you are not based on what we think is best, based on your own personal settings. So by default, we choose short-term, shorter dated options because based on our research, that gives you the best yield long-term if you do this month after month. And then when it comes to risk tolerance, we've chosen by default for most users to be on the optimal track. So not too conservative, not too aggressive. And for any stock that you type in, such as TD, what we do is we provide you with the call that you should sell. And you can enter the number of shares that you own. So let's say you own 300 shares of TD. It presents the strategy to you. So it tells you that you can sell 3 contracts of the December 8th expiration 74 covered calls. So the stock's trading at 72.89. You're effectively saying that in the next 23 days between now and the December 8th expiration, if the stock goes above 74.5 on expiration, you will sell your stock at 74.5. That's a decent return on the underlying shares in the next 23 days. And this is telling you that by selling this December 8th 74.5 call, you'll generate $75 in income. They produce a 5.44% annualized return, and there's a 77% chance that this call will simply expire worthless, and you'll keep the $75 in premium. So the reason that this is an attractive strategy for many of you that are buy and hold investors is because as a buy and hold investor in TD, you're currently earning a 3.29% dividend yield, which is actually not a bad yield in the grand scheme of things. However, by adding a cover call, you're going to add an additional 5.44 on top of that, which brings your total 12-month yield, if you're doing covered calls for the whole year, to a roughly 8.7%. So if you just hold this stock today and you're not selling any calls against it, the most you're going to earn in terms of yield is only 3.2%. But if you add covered calls to this, you can earn up to almost 8.7%. That's why this is an extremely attractive strategy to generate income for those of you that have stock in your account, you're earning some dividends on it, or some stocks you don't earn any dividends on. You might want to add covered calls to add some additional yield. On the stocks that you are earning dividends, this adds additional yield. And our tool is designed to make this as simple as possible. What I mean by that is once you've created your settings, all you have to do is click on a stock and we'll provide you with that starting point. So Bank of Nova Scotia is trading at 83.23. We're telling you to look at the December 8th, which again expire in 23 days, and we're telling you to sell the 85.5 calls. So this is a call that's about $2 away from the current price, and it'll tell you your current yield on this is 3.8% on a stock that pays a 3.8% dividend yield. So you're effectively doubling the yield on this stock. So if you own the Bank of Nova Scotia in your account, you're earning 3.8%. We're showing you how you can increase that 3.8% to 7.6% by adding covered calls. So this is where covered calls becomes an extremely attractive way to potentially leverage options using the stocks in your account to add some additional yield. Especially in this low interest rate environment, everyone's looking for yield for income. Options is one way that you can do that. And again, this is not a comprehensive webinar on covered calls or the benefits of covered calls and the mechanics of covered calls. This is more showing you why you should consider adding options. And if you are interested in this specific strategy, we do specific webinars just on this, so we go into much more detail as to how this strategy works and what you should do in terms of best practices. But lastly, if you want to trade this covered call, you can again click on the trade button. There's also a strategy checklist. Make sure you understand your risks before you place a trade in your broker's platform. So just to wrap up real quick, like I said, you can use options primarily if you're new for two main strategies. Number one, if you're bullish or bearish on the underlying stock, you can just come onto our platform, type in the stock that you're looking at. Let's say you're looking at TD and you're bullish on the underlying stock. Hit the trade button. We'll present to you strategies, whether you're bullish on the stock, whether you're bearish on the stock. We'll present strategies on both sides. We don't have a bias as to where you should buy or sell. We'll present you strategies regardless of what your views are on the underlying stock. And for those of you that own stock that you're sitting on, maybe you're buy and hold investor, use options as a way to generate some additional yield. And our platform makes it a lot simpler for you to find what is the ideal starting point for you when you're trying to sell a call or a put on the underlying stock that you own based on your settings. So use the income tab and it will provide your guidance or provide you with that starting point for those of you that are selling covered calls. So with that, I've taken up an hour of your time, and I really appreciate you guys taking the time out and listening to me for a full hour. I've gone on for quite a bit of time. So at this point, what I'm going to do is I'm going to open up everything to Q&A. I'll answer as many questions as I can. I know there was quite a few questions that came in while I was talking, so I'll start with those first. If you have any questions, feel free to type them into the chat window or into the Q&A window, and I will take them one by one. The first question I got was, what do you think of weekly? I'm guessing he meant weekly. And that's a great question. And I think weeklies are great because it gives you more flexibility in timing an option to exactly the time frame that you want. So options used to trade on a monthly expiration, so you only had options that expired every single month, but now they list weekly options. So the December 8th one that we're looking at is actually a weekly option. From a trading perspective, they're all the same. It doesn't matter whether you're trading a weekly or monthly option. The weekly options just give you more flexibility. So I think they're great. And if you have the ability to trade weekly options, or if you're looking at a weekly option, I highly recommend it because it gives you more flexibility in more accurate timing. I have another question here. Let's see, 1 second. I have a question that says, get out equals selling back the option if there's liquidity. I'm not exactly sure if that's a question or a statement. Michael, if you can clarify for me, that'd be great. I'll come back to you. Daniel asks, you can still exercise at the same strike price, so value is not, so value is not eroded. Again, I'm not sure if that's a statement or a question. If you could, if that's a question, please just let me know what you meant by that. And yes, this platform that's free of charge is only available for Canadian stocks. For those of you that are trading U.S. stocks, there is the same platform is available to you. We do have a special promotion for those of you that are coming through TMX. You can just go to optionsplay.com/income, and that will get you the U.S. version of OptionsPlay. And we do have a special discount on this. If you sign up through optionsplay.com/income, you do get the OptionsPlay US version with the 20% discount. So that brings it down to $40 a month as opposed to $50 a month. There's a question is, Michael's asking that considering your bid-ask spread is not non-significant. Again, I think that might have been a statement to what I was speaking at the time, but if that was a question, please just type your question in again. I have a question here asking, what do the numbers in the three circles mean? Great question. This was referring to the OptionsPlay score. What do these scores mean? So one of the things that we get asked a lot is when you're looking at these strategies, a lot of platforms will break down numbers for you that look like this: cost, max reward, max risk. Some of the more advanced platforms have probability of profit. They tell you what the break-even price is, meaning essentially where the stock needs to go in order for your strategy to break even, and they tell you the days to expiration. But one of the things that we found with this type of analysis is that it's really difficult to compare these numbers because some strategies have what we call unlimited reward, some strategies have unlimited risk, some of them have limited reward, some of them have limited risk, and it's really impossible to compare these strategies side by side. So you have these three strategies, two of them have unlimited reward, so how do you even calculate risk reward with something with unlimited reward, and then how do you compare that to a strategy that has limited reward? So what we realized is that people didn't know how to calculate a true risk to reward, so that's why we created the OptionsPlay score. The OptionsPlay score is simply a risk to reward metric so that you can compare multiple strategies side by side and actually see which strategy gives you the best risk to reward number. Okay, so great question, but the OptionsPlay score is designed to help you understand what the risk to reward of a strategy is, and they're color-coded for you so that you don't have to memorize what's good, what's bad. Essentially, green means good, yellow means okay, red means bad risk to reward. Great question, thanks for asking that. I have a question here. Where are the Greek values? Very good question. So one of the things that we do want to do is instead of thinking about Greeks, and you can think about Greeks if you want to, and it is available, all you have to do is click on the share button, and at the very bottom we have a thing called Explain Strategy in Greeks, and you can find the delta, the theta, the gamma, the vega. We even try to explain the Greeks to you in plain English. So again, this is designed for those of you that are new and learning about these strategies. We try to present everything in plain English as opposed to literally in Greek, pun intended. But I will say that instead of having to know that the Greek on that thing is 0.75 and having to do those calculations in your head, the whole point of our platform is why do that math? We'll do it for you. You just say, I think the stock's going to move down a certain percentage, or I think the stock's going to move up a certain percentage, and we'll calculate for you exactly what the impact on the underlying stock is. This is designed so that you don't have to know your Greeks and know how to calculate it. It's already done for you. So great question. It's available to you, but I don't think most of you need it because we do all the calculations for you. I have a question here saying that I don't find GID CGI. I don't know what that stock is. Is that a Canadian stock, or is that a? I'm not familiar with. If it's CGI is the symbol, then there you go. It's CGI. If you can just clarify that for me, that'd be great. Is there a grid view showing the different strike prices and option prices? Absolutely. So if you type in TD, and if you don't want to trade the December 15th, you just click on Modify. You have the full drop down of every single expiration. You also have the full drop down of every single strike with the price of the strike. But one of the things that we do is instead of having to pick one, you can just move the strike up one if you want. You can move the strikes down one if you want. You can move the expirations out one, in one. This is all designed to help you quickly navigate the different expirations and strike prices. But as the question is, can you see a drop down? And the answer is yes, it's right here. You just click on Modify on any strategy, and you'll be able to see all the expirations and all the strike prices. Frank, great question. I see how you trade an option. Once you own that option contract, how do you sell it? Great question. So, and this is a question that's really more so for your broker, but basically when you buy an option, it's called a buy to open order. And if you need to sell, it's called a sell to close order. So whenever you're initiating a contract, it's always to open. And when you're trying to get out of it, it's always to close. And your broker should be able to help you out with that. Michael, thank you. That was, it looks like his previous comments were answering someone else. Thank you. I have a question here. Thanks for the presentation. If I bought a call option, how to close? And I think I just answered that question. What happens around expiration in the money when we be forced? So that's a great question. What happens if, let's say, you buy this January 70 call, and on expiration date, which is January 19th, 2018, what happens if the stock's at $75 and you own the $70 call? That answer actually depends mostly on your broker, but most brokers will actually deliver you 100 shares of that stock at $70. So because when you buy this call option, you are buying the right to own the stock at $70. So on expiration, chances are you will own 100 shares of the stock at $70. If you don't want that, you simply have to close out your contract before expiration. And this goes back to my point before, is if you're buying an option, you generally don't want to hold it to expiration, because if you do, you're going to end up owning that stock, and that may not be what you want. So you generally want to close out a contract before expiration. But as to what actually happens after expiration, that does differ from broker to broker. So I do recommend that you call your broker and understand how they handle expirations, whether you're in the money or out of it. Justin's asking, if I wanted to close a covered call position, I could buy it back to absolve the obligation to sell my shares. Absolutely. If you don't want to sell your shares, well, keep in mind that you only have to do that if the stock is above the strike price. If the stock is below your strike price, you just let it expire worthless and you won't sell your shares. But if the stock's above your strike price, you're absolutely right. You have to close out that contract, or else they will sell your shares to deliver that to the person who bought that contract. Can you display the volatility in the graph? I don't know which volatility you're referring to, so if you can specify, that'd be great. What does the blue-green circle denote? I'm not sure what's the blue-green circle you're referring to. If you can just clarify as to what you mean by the blue-green circle. Justin's asking, is there a way to tell what the implied volatility compared to historical? Justin, that's not something that we do here on this platform, and there's a good reason for that, and that's really more for a more advanced trader. We're really trying to simplify options here, and comparing something like implied vol versus historical is something that you can find on a lot of other more advanced trading platforms. So if that is the type of trading you're doing, if you're trading volatility, this might not be where you might want to start. But there are many other places that you can go to find those types of charts. It's not something that we currently offer, simply because we're here to make options as simple as possible, and we feel that by adding all of these different volatility metrics, it sometimes just confuses people more. So that's why, for now, we currently do not offer those types of charts on our platform. Frank's asking, you buy through OptionsPlay, but you sell through your broker? No, you buy and sell through your broker. Our platform just helps you identify what options to buy or sell. You cannot actually buy or sell anything through OptionsPlay. Implied volatility. So the implied volatility is actually right here on the bottom. So you can actually, so we can show you what the current implied vol in the option that you're looking at. So this January 2018 70 call, telling you it's currently trading at 11% implied volatility. And you can say what happens if, like, the stock on, let's say, the day after Christmas, changes, if either implied volatility goes higher, if implied volatility goes lower, it'll show you how the change of the option changes based on the implied volatility changes. So that's where you can see the current implied vol, and then assume your own implied volatility if you want, and how the option price will change. That's a bit of a more advanced topic, but yes, you can see it here at the bottom. The question is the circle next to the number score 98. Oh, so this OptionsPlay logo, that just means that it's got the highest score out of these three. And also when you hit the trade button, as you can see, all three check marks are green. So that's when you get that OptionsPlay logo, meaning it's the highest score and all the check marks are green. Let's go to the Q&A section. Which platform to use to trade options? That's a good question. That's up to you. So you usually go to your own broker. There's lots of brokers like Questrade, TD, Scotia, National Bank, all of these brokerage firms, interactive brokers. Whoever you currently trade with, that's who you should probably trade options with. But we are completely broker agnostic. We're just here to show you what options to trade, and you can trade them in any broker that you want. Daniel's saying that I did my first options trade yesterday. I bought 200 shares of CNR. Let's bring up CNR, Canadian National Railway. And also I bought 2 put contracts at strike price 102 with December 1st expiration. Okay, so this person did 200 shares of 200 shares. 200. Whoops. How do I do this? 200 shares of CNR, and they bought a December 1st 102 put. Is that correct? Yep. Whoops, 2 contracts. So this person bought 200 shares of CNR, at the same time bought 2 contracts in December 102 put, which expired in 16 days. And the question is, why do you recommend a longer time frame? Longer time frames are more expensive. And you're absolutely right. So the only reason someone would buy 200 shares and at the same time buy a put option is if they're afraid that the stock's going to drop. Now, the reason I say that you generally want to go a little further out is because you don't want to ever be caught where the stock, you're trying to buy protection essentially here, but what happens if the stock drops 3 weeks instead of 2 weeks out, right? By buying very short-dated options, you're essentially limiting the amount of time that you can be correct, right? So instead of doing that, let's say instead of buying a 16-day option for $1.13, you can buy a 30-day option for $3.85. Well, this is a different strike price, so you can't make that comparison here. Let me see if I can find another. So if we went out to December 8th, which gives you 23 days, it only costs you about 30 cents more, but you're buying protection for substantially longer than when you're buying this December 1st. So that extra week is only going to cost you an additional 30 cents. So this is where what I'm saying is that unless you have a crystal ball that says CNR is only going to drop in the next 2 weeks and it's not going to drop 3 weeks from now, then you absolutely trade the shortest contract that you possibly can. But chances are you might want to give yourself a little buffer room, and chances are it's only going to cost you a little bit more money to do so, But it's up to you as to how you want to structure your trades. But all I'm saying is that if your views are you think the stock's going to drop in the next 2 weeks, there's a chance that it might take 3 weeks to happen. And if you only trade a 2-week option, you're not going to protect yourself against that. And for an extra 30 cents more, you might want to buy that 3-week option because chances are no one has a crystal ball, and it just might take a little longer than you expect. That's why I generally recommend buying slightly longer dated options than you anticipate. I have a question here. Is how do you trade weekly options? You don't. There's no difference between weekly options and monthly options in terms of trading. It's just choosing an expiration date that expires. That instead of on the monthly expirations, which is the third Friday of every single month, so the November 17th is the third Friday of November, so that's the monthly option. December 15th is the third Friday of December, so that's the monthly option, and every other option in between is the weekly option. So there's no special way to trade them. You just choose an expiration date that's a non-standard expiration, and those are your weekly options. Next question is, what needs to be done to take profit and exit? And simply just, again, closing the trade. So when you buy to open, if you need to sell, you just do a sell to close. If you sell to open, you just need to buy to close. So it's always a closing order to get out of your trade. Great question here. If you have time, could you please give some tips on working around the huge lack of liquidity in the Canadian equity option market? So it really depends on your symbol, right? So you're going to find, obviously, concentration of liquidity in the large names that I've covered today, like TD, BMO, ABX. These are large liquid stocks. You're going to find a lot more liquidity. But the best way to work an order essentially is, let's say we're looking at the CNR December 15th call, right? This is trading at 268 by 277. This is actually a pretty liquid name here. Let me see if I can find something else. Maybe an Imperial Bank. This is also a pretty tight spread. Let me see if I can go further out in time. Still pretty tight, actually. Let's see. Pretty tight spread. Here we go. So here you have a bid ask by 55 cents by 70 cents. So that from a percentage standpoint, that's a pretty large spread. So the best way to do is to work an order. So let's say you're trying to buy it and you can buy it at 70 cents and the mid price is 65, is you essentially move your order from the mid price. You might enter the order at 65 cents, see if you get filled. If you don't get filled, try to move it up to maybe 66 cents. If you don't get filled, move it up to 67 cents. And you essentially keep working the order further and further away from the mid price until you get filled. This is really essentially trying to source liquidity because a lot of times market makers will fill you on an order in between the bid and ask price. They just won't display that quote. So you have to kind of go out and searching for it. So the best way to do that is placing your order near the mid price, and start moving your order further away, in small increments until you kind of get filled. That's really the best way to kind of find that liquidity that's actually there. It's just not there on your screen. A question here: the options on CND are always bad liquidity. Actually, I have actually not found that to be the case because the Canadian markets only have one options exchange. You actually have better liquidity, in my opinion, than on the U.S. exchanges because we have 15 different exchanges. It's much harder for market makers to make a market across 15 exchanges versus just one exchange. So I've actually found that liquidity in Canada is not as bad as a lot of people think. And the liquidity in the U.S. is not as good as most people think. I just went through a bunch of examples where I actually, I was looking at a bunch of trades and the spreads were actually very tight. And that's why we created this tool. We actually look at the bid-ask spread and we give you an indication as to how good that bid-ask spread is before you place a trade. Sandra's asking, do you know when the profit arrived from selling cover calls? Is it considered as capital gains or income reporting this? So I don't know anything about taxes in Canada. However, I do know that the income itself is realized when you buy back the call or when the call expires worthless. So the taxable event happens upon expiration if the call expires worthless, or upon when you have to buy back a call, or when you do that closing order. That's when you realize, the gain or a loss. As to how you report that income to the Canadian authorities, that I unfortunately do not and cannot provide guidance on. When selling to close, will the details on the brokerage platform be the same as what was entered when buying to sell? Yeah, so all these details will be the same. So the quantity, the expiration date, strike price, call, and all of that will be the same. But the only difference here is instead of buy to open, it will be sell to close. Most brokerage platforms will be able to help you enter this order. If you already have a position, you usually can just click on a position, click on close, or create closing order, and it should be able to pre-fill the ticket for you. But again, it varies from broker to broker, so definitely call your broker. If you're new to options trading, I highly recommend you to call your broker and have them walk you through your first few orders, just so you're placing them correctly and understand how to do them. I have a question here about trading range simulator. This is something that I didn't cover here today, but I can go over this real quick. But on all of these strategies, we look at, you can see this green and red shading. The green means potential profit, red means potential risk. And as you can see, the green and red is shaded up to a certain point, and the rest is gray. And this is what we do is we only look at what happens if the stock trades within the normal range. What does that mean? Is that TD is trading at 72.89. Based on our analysis, over the next 30 days, it's reasonable for the stock to trade within $70.27 and $75.50 because that's the one standard deviation move for TD in the next 30 days. So the trading range simulator allows you to modify this. For those of you that are a bit more advanced, if you think TD is going to trade in a wider range, or if you think it's going to trade in a narrow range, as you can see, the shading will change, and we recalculate your options play score. We recalculate what is the risk reward of your strategies if the range of the stock trades either a wider range or a narrow range. That's really what the trading range simulator does. You can also say what happens if the stock trades in the 2 standard deviation move. This is, again, a more advanced functionality for those of you that want to take a look at more advanced strategies or more advanced views on the underlying stock. So at that point, that is all the questions I've gotten so far. Again, I thank everyone for taking the time out. It's been almost an hour and a half of hearing me talking, and I'm really happy that I'm getting all these questions because it means you guys are finding some value in this stuff. So if you have any questions, feel free to shoot me an email. We will be sending an email with a recording of this webinar tomorrow. So especially if you're new to options trading, we covered so many things. There's no way I expect anyone to memorize or remember everything. So make sure that you take the time out to view the recording of the webinar. And again, for those of you that have not accessed to OptionsPlay, for the free Canadian version, go to optionsplay.com/TMX. This is the free Canadian version. You'll get exactly what I'm showing you today with Canadian equities for free. For those of you that trade U.S. equities, go to optionsplay.com/income. This will give you a discounted version of OptionsPlay because it will, for the U.S. version, it is the exact same platform, but it allows you to trade and enter U.S. equities in there. And for the TMX, we have a special 20% discount, brings the monthly cost down to $40 a month or $400 a year. So again, thanks everyone for joining this afternoon. I hope you guys have found this useful. And we will be back in the next few weeks to do more webinars, and you'll get an email once we have that scheduled. Thanks, everyone. I hope you guys have a great afternoon.